Hello and welcome to Livewire Markets Fund in Focus. My name is Anna Dadich. Today I am joined by Mike Schueller, Senior Portfolio Manager at Allspring Global Investments. He's going to be talking to us today about the new Allspring Global Income Fund that has been recently launched in partnership with Bennelong. Hi Mike, thanks for joining us.
Hi Anna, thank you for having me.
So we're here to discuss the Allspring Global Income Fund. What is it, what's in it, and who's it designed for?
The Allspring Global Income Fund is a global multi-sector fund. So that's a mouthful, but what does that really mean? It means that we can invest in fixed income sectors across the globe. So that spans from US Treasuries to global government bonds, includes currencies, it includes corporate credit in the United States and in Europe, both investment grade and high yield, as well as emerging market in local currency or in US dollar. So we can go anywhere throughout global fixed income markets searching for dislocations that we can exploit to create extra income for our clients. For our clients, this is really designed to be a foundational fixed income portfolio that serves as a great diversifier of their more equity-like exposures, offering attractive income, and with a management team that has a history of being able to shift allocations when opportunities arise in global fixed income markets.
Okay, so what makes the fund structure and approach different from other global fixed income products?
Our approach is a little bit different in that we focus on what we call our 6-month outlook. So as we're analyzing markets or assessing relative value across sectors, we're trying to really focus on what do we think is most likely to happen within the next 6 months to give us a better chance of accurately assessing that outlook and then gaining the correct exposures for our clients. It's not that we ignore the future or longer term time horizons. It's just that we think this is the best way to create a higher conviction portfolio because there are fewer things that we have to get right within the next 6 months as opposed to taking a longer term horizon.
Your sector specialist model is a key part of the process. How does this help uncover opportunities that may be overlooked?
So we have 6 portfolio managers, and as you mentioned, they're each sector specialists. My sector specialty is US high yield, but we also have managers who focus on US investment grade credit, asset allocation, global credit, emerging markets, and European credit as well. Each of those sectors, in turn, works with a staff of analysts who are also experts within their particular sectors and are well tenured with a lot of experience and familiarity with those sectors. And what we think that enables us to do is uncover what we call idiosyncratic opportunities. And security selection is a key part of the alpha generation of our product. And we think that's important because that is a more repeatable model. Duration is a great lever to pull to generate returns. It's really hard to get that right. We will pull that lever periodically, but we think it's important to have a key part of that alpha generation come from security selection, which is a key part of our process and has been for decades.
You can pull more levers than most fixed income managers. Which levers, duration, sector, curve, currency, are you actively adjusting right now and why?
So let's start with duration and curve first. We've recently increased duration within the fund to about 4.25 years. The key driver to that is we do think that global economy is set to slow a little bit between now and the end of the year, which is the next 6 months. We think we'll avoid recession, but that combined with inflation levels that are the best we've seen since COVID, we think provides the opportunity for the Fed to cut once or twice through the end of the year. So we think that treasuries offer a potentially attractive opportunity from that perspective. Now, if we think about curve, we also think that the long part of the treasury curve is susceptible to moving higher. And we think that's driven by continuing ongoing fiscal deficits within the US, and concerns about the long-term viability. And inflation does remain somewhat elevated. So we think that means that there should be a higher term premium. In other words, investors need to get paid a little bit more to take that risk. And so we are short that part of the curve, and our investors will benefit if rates rise on the long end. From a sector perspective, we do think that corporate credit is extremely rich right now. Spreads in the United States and Europe are close to as rich as they've ever been. Contrast that with the US agency mortgage-backed security market, where valuations are closer to longer-term averages. So we're overweight that portion of the market at the moment. That's a high-quality sector. We think it offers attractive income relative to corporate credit. We are underweight, particularly the high-yield parts of the market, both in the US and in Europe. Again, we think valuations are priced almost for perfection and really assigning almost a 0% probability of anything negative happening. So this leaves us in a position where we're generating attractive income for our investors, but we have the opportunity to reallocate to the riskier portions of the market should the valuations become more attractive.
The fund's current yield is materially higher than the benchmark. How are you delivering that premium while still focusing on capital preservation?
Well, the fund's yield is higher than the benchmark. It's roughly 6% at the moment. What we're doing to maintain that, there are a couple of things we're doing to maintain that. The first is we're investing in US agency mortgage-backed securities. We think the valuations there are closer to average, which looks attractive relative to corporate credit. So we have a large allocation to that portion of the market. However, we're not ignoring corporate credit entirely because we do find that an attractive place to source yield for our investors. The one thing we have done is we've moved our exposures there from longer dated bonds to shorter dated bonds. That allows us to maintain most of the yield, but puts us at a part of the investment grade corporate market that has lower volatility should we see a risk sell-off within the market. So it maintains exposure to investment grade corporates, but a much less risky and lower volatility portion of that market until such time as we have better opportunities to reallocate portfolio assets.
Okay, so finally, what's the strongest reason for investors to consider the Allspring Global Income Fund now, given where we are in the cycle?
Well, if you look back to the period following the great financial crisis, particularly in the United States, yields generally were quite low. That has changed. We have much higher yields, in the US, anywhere from 4.5% to 6%. And we think that offers a really attractive income stream that provides enough yield to offset volatility, should there be volatility. The other thing I would point out is that we do have, as you mentioned, a sector specialist model. We have a process that enables us to quickly react to changes within markets. Global fixed income markets are highly segmented. We think that creates persistent inefficiencies. Our process and philosophy is designed to take advantage of those inefficiencies, and we can do that very quickly, much more quickly than an investor can do on his or her own.
Thanks, Mike, for sitting down with Livewire today and telling us about the fund.
Thank you, Anna.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.